Well, in some more breaking news coming in, the Reserve Bank of India has announced that the fourth bi-monthly monetary policy review, saying that it was keeping the policy rates unchanged in a bid to maintain financial stability. There you have it, news coming in of the RBI announcing the fourth bi-monthly monetary policy review and saying that the key policy rates will not be touched. This to maintain the financial stability. That's the latest.
Well, many of you have already read the policy. Just a couple of points there. As far as the rates go, we didn't make any move. But I think what you should read in the policy is both our views on the evolution of inflation going forward, as well as focus on Part B, where there's a substantial number of actions that we have taken to facilitate growth and development of the financial sector. So with that as a preamble, I think we're happy to take questions.
Yes, Anirudh.
Good morning, Governor. Anirudh here from ET Now. So we all know that you don't like to be branded as an inflation warrior, but clearly going by the kind of guidance that you've given and the kind of risks that you've outlined on the 6% inflation target by January 2016, one does seem to get the impression that we might not see any kind of easing and possibly a cycle of rate hikes if you don't kind of reach that objective by then.
See,
I just want to understand your views on that.
I don't think you should read that into the policy. What we have said is that we are currently positioned to reach the 6% by 2016 January, given where the rate is. Now, there are a number of disinflationary forces underway, which we've talked about. The low oil price is one of them. The fact that we have a relatively stable exchange rate is another. And the fact that wages, especially in rural areas, haven't grown as fast as in previous years is another positive factor for inflation. All these will combine to continue the disinflationary process we see reflected, for example, in core inflation. Headline, of course, has been buffeted a little bit by food inflation. There are uncertainties still, one of which is how food inflation will evolve over the course of next year, but there are also positives. And what we have to see is how this plays out. Now, I know there is some discrepancy between our modeling of inflation, which says that the expected level by 2016 is 7%. Of course, those are models, and the inflation stance or the policy stance is taken by all of us, putting our judgment also to work. And our judgment is that given all that we know about what is happening, we feel, and some of it is model plus some subjectivity, that we can still reach 6% by January 2016, given where we are. Now, of course, there are uncertainties, and therefore, given our model is saying is 7%, we're saying that the risks are still to the upside, though they've come down since the last policy meeting because the inflation readings have been better, the monsoon has been better, etc. What we end with the policy paragraph is that our actions will be based on a projection of inflation. We need to reach 6% by 2016. I think there's broad agreement that that is what we are trying to do. But it will be contingent on incoming data. So as of now, we are reasonably set. As of now, our expectation is we will reach that target. But of course, a lot can happen in the world.